you've got a good handle on the retail investor. What are they doing amid all of these wacky market moves?
Yeah, so for the last couple of weeks, actually, Sarah, they've lightened their exposure to equities overall and gone a bit toward fixed income and really shorter-term fixed income. As last week when we had the bigger sell-off, it gave them an opportunity to buy some stocks in general. But I think many of them are kind of hanging tight a little bit and just kind of letting this all play out. We know, every day we're tweet-driven or, rumor-driven or whatever it may be. We do have some retail earnings, at least to give us some guidance. But in general, I think it's been a little bit of a strange time. And, you talk about Jackson Hole later this week. It seems so long ago, a year ago, we went in there talking about 3% 10-year rates, and was the target going to be 4.5 or 5 for the next 2 years?
Yeah, I mean, how are you thinking about the action in the bond market, Matt, versus what we're seeing in stocks? The rebound today clearly helping sentiment.
Yeah, well, there's certainly in the bond market has been a bull market in gloom, so to speak, right? And understandably, you've got all the negative rates over in Europe. You've got the manufacturing slowdown you talked about before. I think, Sarah, the way we reconcile it is that this cycle has been a series of cycles within the cycle. And what we're seeing now in the manufacturing sector is a cycle there. We saw that in oil in 2015. And in some way, that prolongs the whole cycle. We don't necessarily think that's a forward-leading indicator for the whole cycle to roll over.
You think it's just manufacturing?
At the moment, trade, manufacturing, that sector, it's significant. But is it enough to bring down the whole economy when the consumer, as you noted, is doing quite well?
How does a manufacturing recession or an outright recession sustain the broader growth cycle? Is that your argument?
Yeah, in the sense that it keeps the excesses from building, right? So we have these little washouts. We had that in 2015. And let's back up. We're certainly late in the cycle. Let's be clear about that. And that means we're more vulnerable to these downturns. So everyone, of course, is on edge. So this is really what late cycle looks like. You have slowing growth, and then you have the ability for any sector to bring down the broader economy. So people are trigger happy. So we saw that last week. And then people get comfortable with the fact that, okay, the broader cycle is prolonged by having these mini cycles as opposed to one large cycle like we saw in 2008.
What about earnings expectations? Where do they sit for the rest of the year?
They're okay, not great. They're, again, like we saw in 2015, we're having the manufacturing cycle put pressure on the earnings picture. And so we have muted earnings growth for a couple of quarters. And then hopefully, assuming everything's still on track, we'll have some gradual acceleration. In late cycle, though, you don't get the big lift that we saw from the tax cuts, et cetera.
JJ, you said your clients were taking the selling last week as an opportunity to buy stocks. What kind of action did you see in which stocks?
So one of the things we've seen, Sarah, is, they've been a bit of sellers of Apple over the last few months. As Apple came down, seeing some opportunity there. Our clients continue to like on the sell-off. Uber has been, particularly of our millennial clients, a stock that many believe in. People may say they don't have earnings, et cetera, and I totally understand that. But I think one of the things is, using their parents who said invest in things you believe in and use in the longer term. I think that is definitely sit with that generation in terms of something they are using. And one thing I will say about the market overall, in terms of recession or whatever it may be going forward, I think one of the things that these tariff overhang has continued to do is it basically keep us range bound on the S&P between 2,700 basically on the downside, 3,000 on the upside, because it's the fear of missing out as we get to the low end of the cycle for many people, and oh my God, I can't buy this here in case it's settled in a bad way to the upper end. And I think we're going to continue to see that overall until we actually do have something on the tariff front that's more definite.
So you think the China trade put is intact, JJ, right? And you think it's right around 2,700?
I do, Carl. And the one thing actually about earnings that concerns me is not so much the earnings themselves, but the fact that if you listen to the earnings calls, nobody's talking about investing in infrastructure. I actually think the damage that may be done is a couple of years down the line, 2 to 3 years down the line, because we're not hearing an infrastructure talk at all, because as a CEO, you're okay buying back stock is the best use of your cash right now. I can't blame CEOs for not investing in plants or whatever it may be because they don't know where this is going to end. And so once they know the rules of the game, they can win the game. Right now, they don't know what the rules of the game are.
So finally, I mean, you've got a strategy, stay overweight U.S. stocks, but you don't like small caps?
Yeah, that's right. In late cycle, this is the kind of profile we get. We get slower growth. The pace of gains are slower. You want to stay in high quality assets, and you'll have a lot of volatility.